Hey everybody, welcome back to my channel, Surpass Money. I'm about 4 or 5 videos into recording this week. I figured if I have a topic on my mind, I'm just going to talk about it. Hopefully I can think of different content. Today I want to talk about your home, your mortgage. Not everybody's going to be paying for a house cash. Most people are going to be taking out a 30-year mortgage. So how does it relate to retiring? Should you pay your mortgage off early? And I haven't gotten into it yet, but I named the channel Surpass Money because, you know, you need money in order to do just about everything in a society in order to buy things that you need. But if you go beyond money and not just think about as that's the only thing that you need, that'll be a better way to look at things, especially when it comes to retirement, because a lot of things are emotional. And I think a mortgage is kind of like that too. So I bought my home 20 years ago, so 2004. At the time, I think my interest rate was 5.4%, which at the time was pretty good. I ended up refinancing down maybe 3 or 4 years later to a 15-year. They normally say, like, if you could drop down at least a point, it's worth refinancing, which is what I did. I don't remember what the rate was, but it was 4 something. And the closing cost just got rolled into the mortgage, and then I ended up refinancing a second time into a 10-year mortgage, which I didn't even think you could get those, but I found one for 2.75. Now, this was a while ago. This was, I think, 2015 or something like that. So I know people a couple of years ago were getting 3% mortgages on their home. So historically low rates. So even the 10 year that I got at 2.75 for the time period that I got, it was really good. I ended up paying it off maybe 3 years early. Financially, it probably didn't make that much sense, considering that was a really low rate, and I probably would have made more money elsewhere. Although at that time, I couldn't just put it into an online savings account and make more than that, or a treasury bill like I can today at 5%. If I still had that mortgage and I would have been able to risk-free get 5%, I would never have paid it off. It wouldn't make any sense. Back then, the interest rates you could get on a savings account was a lot less than 2.75%. So I paid it off early, and paying it off, you can't always think of it as a financial decision, because you get this, it's this feeling you get. It's emotional. Like, for most people, that's your biggest expense, your biggest purchase that you ever make. And assuming you have no other debt, paying off your mortgage is the last piece of debt that you're going to have. So the feeling of not owing anybody anything anymore is a really good feeling. Now, I kind of joke with people. I'm like, well, I don't really own my house, because property taxes, and if I don't pay those, they could put a lien on my house and take it away from me. So it almost feels like I'm renting the house, still, even though it's paid off. But you're gonna have that no matter what. and the maintenance and all that. But you do get that freedom sense of just being debt free, which is something that I always wanted, and I never liked debt at all. Like, I don't like something lingering over my head that I owe somebody something. If I get a bill, I pay it right away. I'm like that person that, like, I'll pay my credit card bill. I never pay any. Um, Very rare have I ever forgotten to pay a bill. So it just gets paid right away. I don't make purchases that I can't pay for right away. So if I can't pay for it at the end of the month, then you can't afford it. That's kind of like how I look at it. But if you're going to be retiring, you certainly would want to at least have your mortgage paid off, ideally, because, like I said, that's your biggest expense, more than likely. And then having that out of the way is going to give you a little bit more freedom. The money that would have went towards the mortgage, you can invest into something different. But it's just one less expense that you have to worry about. So, I've had the house 20 years. I think if mortgage rates were like, if you were just buying a house now and you had a 3% mortgage rate, you're probably going to make more money in the market than you would if you got your interest rate at 7%. So if you got a couple years ago at 3 versus 7, that's a different story. If it's at 7, historically, the stock market, you get 8% year after year on average. There's no guarantee of that. So at 7% mortgage, I'm probably going to work towards, throwing more money at the principal to shorten the amount of time. At 3%, that's leverage there with money. I probably wouldn't. At that rate, you're probably going to be able to make more than that fairly easily. You should. So, especially now, like on a savings account. So I wouldn't necessarily, in that case, be trying to pay it down any faster. But if you're the type of person that just doesn't want any debt, then you got to do what's best for you. But it's not always dollars and cents. It is that feeling like after I paid off the mortgage, it just, just knowing that you don't have another payment, just, psychologically, it's an emotional thing. And I'm glad that I did it. If I still had the 2.75% in this environment, I wouldn't have. But it's got to be clear cut. If you're, at 3% and less, I wouldn't pay it off. But anything more than that, 4 or 5%, then you're starting to, you might not make more than that in your investments, depending on what you invest in. So when it does come to retirement, retiring early, and if that's your goal, then trying to pay down your mortgage quicker, sooner than later, is something that you should be doing. And it'll just give you that freedom. And again, you could take that money you would have invested for the mortgage and use it for something else. Of course, you still have to keep an account with your property taxes going up every year and certain percentage for maintenance, and your property taxes aren't coming out of your mortgage payments. They aren't being held in escrow anymore, so you're paying your town directly. So you got to budget a little bit differently. Like, I make two property tax payments a year, so I gotta, and they're not cheap, especially here in New York. So you gotta keep that money aside, because when it comes time to pay it, you got to make sure you have it. Whereas before, it was kind of like automatically built into your mortgage payment. Part of it was principal, interest, and property taxes and stuff like that. So what do you think? Should you pay your mortgage off early? Do you like that feeling of not having any debt over your head? Would you rather just have that mortgage payment and use the money for something else because you're figuring you're going to make more money with it elsewhere? Leave some comments down below and let me know what you think. If you can, please subscribe and like the video. It'll definitely help me get the channel off the ground, and appreciate you taking the time to watch these videos. Thank you.